Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a schedule of cash payments, a bit more complex of a scenario than we had in a prior presentation for the schedule of cash payments. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you'd like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 431 Schedule of Cash Payments More Complex tab in the Practice Problems section. Closing this back up, we're going to have our information up top, then we'll have a little bit smaller component of that information that we can then use to work through our practice problem. We're looking at the cash payments, we're looking at the outflows here. So the expected sales that we're going to have are going to be for January through June given to us. And then we also have July's expected sales, and it's red here because that means it's not part of what we're going to need in our cash projection because we're only looking through January through June, the first half of the year here. But in order to calculate it, we're going to need this number for July, which is a little bit different than what we've seen in the past. But so that's going to be kind of like a new thing, which is exciting. And then we have the monthly materials purchases, percent of sales for next month. So in other words, when we think about the purchases that we are going to be making, we're going to be purchasing them based on the projected sales in the following month, which is a little bit different. And notice when we think about the purchases, we can do the purchases multiple different ways. There's no standard kind of way that we can set up the purchasing process. It's not like this is the way it goes and every company is going to be the same, as it would be under certain components of past history recording, like accounting for generally accepted accounting principles. When we're thinking about projections into the future, then management's going to have to think about, well, what's the best system I want in order to make the best decisions I can. So what we're going to do is think about the purchases that we're going to have, possibly for materials, and they're going to base the purchases on the sales projections for the following month, which is why we're going to need this July information up top. So then we have the percent paid in the month of the purchase. So we have that same staggering problem with the cash outflows as we had with the cash inflows. The cash inflows going through accounts receivable before we then collect on it. The cash outflows going through accounts payable possibly before we then pay for it. Therefore, we're going to have the purchases collecting the money, or we're going to get the stuff before we pay for it. It then going through accounts payable, then we pay off the accounts payable in the following month. So we have the percent paid in the month of purchase, meaning the amount that we purchased and we paid for it in the same period, meaning you can imagine we enter it into the system, entering the expense or the asset of inventory of the materials, and the other side going into the accounts payable liability. Then we paid off the accounts payable in the same month. The percent paid in the following month, meaning we entered the bill, we increased the liability of the payable, accounts payable, recorded the asset or the expense, and then we paid it off, decreasing the liability of accounts payable and decreasing cash in the following month. Labor costs per month are going to be $4,500. The fixed overhead is going to be the $4,000. Interest payments paid March and June. So these are going to be interest payments. They're telling us when they're paid, when the cash actually went out. Notice that's a little bit different than what we would see on the income statement. On the income statement, we would assign the interest expense in accordance when it was incurred, when it was used in order to generate revenue. So we would see interest expense for each month, most likely in an even proportion, or one that would be applicable to that period in terms of use. But here on a cash basis, on a cash flow basis, we're going to be doing the interest expense only for the time periods when we actually pay them or expect to pay them. So then we have the commission percent on sales. So we're going to say that there's sales numbers and we're going to be paying commission on the sales number. We're going to pay all commission for the 6-month period at the end of June, so June 30th. So that means, again, this will be different than what you would see on the income statement if we were recording the income statement on an accrual basis, meaning on an accrual basis, we would be recording 2.5% of the sales for each month in the period in which those commissions were incurred. But on a cash flow basis, we're not going to record them until we pay them, which isn't going to be until June. All right, same information is going to be here in a smaller setup so that we can then see it as we work through the practice problem. We're going to set up our practice problem here. We have the estimated cash payments. So this is a schedule of cash payments. And note that the red months, December and July, are outside of the period we are looking into. We're covering January through June. We have December and July so that we provide information that will be necessary for us to calculate the flows in a way that can then be seen all in one table for the period covered the first half of the year, January through June. So then we're going to say that we have the sales then. Sales including the 16 all the way to the 24, the 16 through the 24. So we have the sales number. We need the sales number in order to calculate the purchases that we are going to have, because the purchases of the material we're basing on the sales number. So again, this is a little bit different in that we're saying, and you're going to have to read the problem carefully or think about in practice how you want to base your purchases number that you're going to be having. They're going to be basing it on the next year's sales. So in other words, monthly materials purchases are going to be 35% of next month's sales. So here's next month's sales number, which is the 16,000 times the 0.35. Now this might make sense if we're actually like producing the inventory, because we might be saying, hey, look, I need to predict what's going to happen next month so that I can make the inventory, right? So then I want to see what the sales are going to be. I want to see how much inventory I need with relation to the sales number for the next month so that I can then produce the inventory up for that time period. And notice also that the sales and the purchases for the materials that we make in order to make something that we're then going to mark up and sell, should have some fixed kind of relationship oftentimes. Therefore, it might be reasonable to predict the purchases based on the sales number. So that's what we're going to have. So we're going to say purchases 5,600. Again, December's outside the period that we're looking at, but I need to record the purchase amount that we're going to have here so that I can then think about the cash flows related to it, because we're going to pay for some of those purchases the month after, in this case, the month of January. So we're going to purchase them here, and we're going to pay for some of them in January. So if we did this all the way across, then we would go then to February here, and we're going to take the 18,000 times 0.35. That's going to give us our 6,300. And then we need to look at March to pick up, so 21,000 times 0.35. That'll give us the 7,350, and so on and so forth through our problem for the purchases. Then we want to think about the payments. So now this is just the setup information we have here. Now we want to think about the actual payments, because remember, the purchases aren't necessarily tied into the payments. That means we purchase them on account. That means they're going into accounts payable. When are we paying off the accounts payable? What's going to happen with the cash flows? So for that, we're going to start off with the materials, because those are the items that we assume are going through accounts payable, the most difficult to kind of consider here. And we're then saying that, so then of the purchases we have, we're going to say that these are the amounts that went into the accounts payable in those months for the purchases that we had that were then owe. And we're going to pay 40% of the purchases that were made in the current time period, and then 60% in the following time period. Now, we're only going to have one line item to do this. We could have broken this out into two line items, and so we could see the 40% and the 60%, but we're just going to have all purchases that were paid for, the materials payments, in the same time period. So we're going to have to do like a double calculation here for this row. To do that, I'm going to use a scientific calculator just so we can see the formula. So to do that, if you're in Word and you're using this calculator, you can make it a scientific calculator apparently by doing that. And so then we can see this a little bit more easily. So we're going to say, all right, then of this 6,300 of purchases in January, I can take that, I'm going to put brackets around it and say the 6,300 we purchased in January, and then I'm going to say times 0.4, we're going to pay for 40% of those. Plus, and you can see the little formula up top. Then we're going to say of the 5,600 of December that were purchases made last December, I'm going to put brackets. That's going to be the 5,600. We're going to say times, we're going to collect 60% of those in January, 0.6. And that's going to give us then, enter the 5,880. So here's the formula up top. So let's try that again. We're going to say, all right, well, how about for February? If we take February here, take February, let's put it here. That should be enough. And then we're going to say, okay, let's clear this thing off. Let's clear it off. We're going to take the current period, which is going to be, I'm going to say brackets. It's going to be the 7,350 purchases. that we made in the current time period. And I think it didn't pick up my bracket here. Where my bracket here? Let's try it again. Bracket here, and then we've got the 7350 times the 0.4 collected in the current period, and then brackets, and then plus we've got the prior 6300. So I'm going to say brackets, and we'll say 6300 times 0.6 that we're going to collect, and close the brackets, and there we have it. So there's the 636720. Let's do this one more time, and then we'll assume this same process across. So these are the purchases we made in the current month. So I'm going to say, all right, brackets 9100. See, it didn't make my brackets again. Why isn't it making my bracket? Bracket, now I have two. Bracket, and we're going to say 9100. We're going to multiply that times 0.4 collections in the current period, close the bracket, and then add that to, and then add brackets. We're going to say the prior purchases 7350 times the collection that we're going to have in March for the prior purchases 0.6, closing up the brackets, and enter. So there's the 8050. So these are going to be the payments that we're going to be having. I'm going to switch this back over to the normal calculator now, because it just sticks on the window when I click on it. Okay, anyway. Then we're going to say, what else do we have? We've got the labor. So the labor we said was 4,500 all the way across. So that's straightforward. So that's just going to go from January to June. We're just going to put the 4,500. That's going to be the standard outflow for labor. Possibly we're saying it's salaried labor maybe, which would all be the same as opposed to hourly, which could vary. And then we're going to have the fixed overhead, once again, often a fixed amount like the rent or something like that. Therefore, it will be nice and easy for us. The cash flow should be even all the way across. Then we're going to have the interest. Interest is a little bit more complex because the interest we're saying is going to be paid on March and June. Therefore, we're going to have to put this into our cash flow for March and June. Remember that on the income statement, if we were looking at a monthly income statement, each month would have interest expense from an accrual basis standpoint because we incurred the interest of financing. We took out a loan. We got the purchasing power. We used the purchasing power each month, even if we're not paying for the interest, the rent on the purchasing power until March and June. So this is going to be a difference between what you'd see on the income statement, the performance statement, the expense on the income statement, and what you would see on a cash flow statement, the outflow of cash happening here, not being in alignment with the use of the cash in that particular case. Same thing going for the commission. So we're paying sales commission of the 2.5% of the sales. So what we're going to do there is we're going to say, all right, it's the end of the 6 months. We promised 2.5 sales commission. So we had 16,000 plus 18,000 plus 21,000 plus 26,000 plus 16,000 plus 22,000 times the percent 0.025, which is 2.5%, moving the decimal over 2 places to the left. That means we're going to owe 2,975, which we're going to pay out in June. Now, once again, if we're paying sales commission in June, it doesn't mean that the sales commission wasn't earned throughout the time period, meaning in January, you would expect to have on the income statement 16,000 times 0.025, $400 on the income statement. February income statement, 18,000 times 0.025, because we would have incurred those expenses on the income statement, even though they had not yet been paid. But in a cash flow statement, we didn't pay them until June, and therefore we pay the whole part over here in June. And then, of course, if we were to add these up, we would be adding up only these items, the 5880, the 4,500, the 4,000, adding this up here, and adding all these columns up, and that's going to give us basically our payments that we'll have from January through June. Really good problem here to practice this in Excel. So I would highly recommend practicing in this Excel both for the cash payment schedule as well as just making tables like this. This is the bread and butter of Excel, making tables like this. These are perfect problems to practice the bread and butter of Excel. Or Google Sheets, by the way. If you want to use Google Sheets is fine. This stuff, basic spreadsheet stuff, it'll work on pretty much any spreadsheet program. Both Google Sheets and Excel can handle this with no problem.